I recognize many of the faces here, so I'm very glad that you took the time to come here. My presentation is really not a presentation. It's really to set the stage for Jilesh. This is my only slide. So I just want to kind of conceptualize, I think a lot of just looking at the faces here, many of our clients or many of us are with companies that I would call middle market, closely held companies. And so if you have a closely held middle market company and you want to go do work in India or really any place outside the U.S., what are some of the ground rules and things you have to be thinking about in terms of your U.S. tax structure? Well, the key driver is under the U.S. Internal Revenue Code. Whether you're a U.S. individual or a U.S. domestic corporation, the U.S. taxes you on worldwide income, baseline. And you have to understand that. You hear so much talk, and we're going to talk about it today, about deferring income offshore. That's done through the use of foreign entities that are controlled in some manner by the U.S. shareholders. There has to be some sort of economic substance to the operations outside the U.S., but you have to understand that if you take your regular New Jersey S corporation, you start, we talked earlier before about maybe having a permanent establishment by accident. Now you've exposed that income to federal U.S. tax. You have to think when you're investing in India, what is your long-term plan, like Sajay said? Are you going to take the profits and reinvest them and grow your Indian and South Asian business, or is the plan to repatriate dividends? That's going to be a key decision you have to make in terms of the type of structure. And then the other thing Sajay mentioned is that the ability to convert rupees to dollars is a very important threshold. And you may want to pay yourself a dividend and may not be able to. So, or you may be buying a piece of property, sell it, want to bring back the cash. You may have some obstacles. So you have to have that well planned in advance. Conventional U.S. tax structure, we're very used to thinking of flow-through entities, S-corps, LLCs, because we know that we only pay one level of tax, and one level of tax is better than two levels of tax. In the world of offshore planning, it's usually the opposite. We want the equivalent of a U.S. C corporation, because we want a private limited company in India that will not be subject to U.S. tax until we affirmatively push a button and send ourselves a dividend. Okay, so typically speaking, the structure is Indian subsidiary, U.S. Parent. I've had many horror stories where people, for whatever reason, don't want their Indian affiliate to be owned by them or their corporation. They'll set it up in the name of some relative or a friend or a business partner. And it makes life easy and it helps you get off the ground running. But then when you start to build value and you really want to fix this, or Microsoft comes and wants to buy you, they don't want to buy your brother's company, they want to buy one unified structure. And how do you bring it back all together when now there's a real deal on the table and there's real value? It's very difficult. Transfer pricing is a huge topic. It's probably a bigger topic in India than it is here because it's more common even at the lower levels. Revenues of $10 to $20 million in India, it's a big issue where it's less of an issue here, but it is important. If I'm a U.S. corporation, I'm forming an Indian subsidiary to do back office work. What's the right rate to pay the people? What are the services they're doing? We have many, there's a tendency when the subsidiary in India gives you the phone call and says, we need cash to make payroll, you send over cash. Well, you really have to have a transfer pricing study. There's got to be documentation, invoices to support who are you paying and what are they doing, and are you paying them the same rate that you would pay an unrelated party? And then finally, not directly related to what we're talking about, but FATCA, which stands for Foreign Account Tax Compliance Act, is something that is having a huge impact. In its most direct form, it is legislation that was passed in 2010 that requires all foreign banks through a series of sticks and carrots to report to the IRS any U.S. account holders that they have to the IRS. And as this has become more and more gotten more and more closer towards implementation, the U.S. has developed some collaboration with other countries because all countries have a common goal. They want to find each other's tax cheats. So in terms of bank accounts, in terms of just business disclosures, if I have a corporation and I have a subsidiary in India, there are disclosures that are required, and the penalties, you would fall out of your chair if I told you some of the penalties for not following some of these required forms. So as an offshoot of FATCA and just the globalization and every country's working together, compliance is becoming more and more important. So with that, that's kind of my foundation. I'll let Jilesh take over, and I may interrupt you during your presentation.
And Caleb and Sajay in the earlier presentation have already laid a foundation in terms of what India is at this juncture. So I'll just go directly to some of the tax aspects and doing business in India from a tax and a regulatory standpoint. Now, the tax structure what we have in India, I've just laid down the few acts which are relevant. In terms of the Income Tax Act, India has only a federal level taxation. So unlike in the US, where you have a state level tax as well as a federal level tax, from an income tax perspective, it's only at one level, which is at the federal level. So that is what is relevant. A wealth tax is, again, is a tax on wealth accumulated. There are reasonably high thresholds and generally applies, to individuals and companies. There are very few things which covers that. In relation to indirect taxes, unlike the direct taxes, we have multiple indirect taxes broadly depend upon the nature of activities and different states or how they've done. Just to give an example, let's say if you are importing something, custom duties is something which is most relevant. If you are manufacturing something in India, then there's an excise duty which is applicable. Now, in terms of a trading, when you have in the US, you only have the VAT. India have two distinct tax. We have the VAT Act, which is primary for sale of goods. However, if there is a sale of services, the Services Act comes into play. Then there are these, few other octroi when there's transport of goods and, R&D, whether it's research and development. Now, what is critical is, most of these indirect taxes are dual in purpose. So there are some which has the federal level has a sole right. There are some which only the state level have rights. And therefore, at times what becomes is, it's contradictory for a service or, for a particular type of activity which cannot be classified as goods as well as services. You'll have the state level guys saying that this is a good and therefore a VAT should apply, whereas the central level would be saying that this is a service or there's a service element embedded into it and therefore there's a service tax which applies. So it's, it's something, which is worth noting. And depending upon on the products or the business which you are trading in, it does become critical in looking at it. In terms of transactions, pretty much there's a stamp duty on any transfer of shares or immovable properties and so forth. And there is a security transaction tax, which is fairly recent, which applies on which is a nominal percentage, but it applies on every trade which has happened through a recognized stock exchange in India. So we have the two largest stock exchange which we have is the National Stock Exchange and the Bombay Stock Exchange. There are benefits of the STT. Capital gains is exempt. So this was something which was introduced around, I would say, 5 to 7 years back, and it is applicable only on trades happening through stock exchanges.
Jilesh, let me interrupt you. That for individuals, that's a problem we see a lot because people will have exempt sales in India and they don't realize that it's still taxable in the US.
That's correct. That's correct. So what happens is, and that's a good example. So let's take a very simple example, for a US resident individual or a US company who have done a transaction in India on a stock exchange. So they would have paid the security transaction tax. And, if it's a long term, which is more than 12 months, then India would not tax that. So from an Indian perspective, that's an exempt income and the individual can take the entire money back. But from the US,
Right, it would be a taxable event.
So that's something which needs to be taken care of, and we've had few instances in the past where after the deal or after the transaction was done, the US tax or the US part were realized. Now, in terms of some of the changes or which we are looking at, India is at a pretty interesting position or situation at this moment. As Sajay mentioned earlier, most of the laws which are there in India are dated back. Largely coming, from the British era and then the subsequent changes. So, we have all the different acts. Most of them are currently undergoing changes. The one which we spoke earlier was the Indian Companies Act, which is now effective, largely from April 1, 2014. And at the same point of time, we have few other legislations where the draft has been circulated. And the reason why I wanted to mention this is because some of them could have a far-reaching, impact on your business in India. And, there are few critical aspects which needs to be considered. In terms of the direct tax, which we spoke earlier, so the current act what we have is the Income Tax Act 1961. That is sought to be replaced by a new act or a new code altogether, which is called the Direct Taxes Code. It's been 3 to 4 years now. The first draft was made available to public. There have been representations, and then there have been revisions. There have been committees which have been formed. As recent as early this month, we had the latest draft of the Direct Taxes Code, which was again made to public. And few of the aspects which I wanted to talk about it is, there are certain thin capitalization rules which it proposes. There are anti-abuse provisions, which the DTC originally, the first draft of DTC when it came, they introduced the anti-abuse provisions, or GAR, the General Anti-Abuse Rules, as it is called in India. What has happened is, that it was part of DTC, but the Income Tax Act actually took in, and in few of the budgets, there were amendments. So we have the General Anti-Abuse Rules, which are now part of the Act. However, they are effective April 1, 2015. And these are large, these are, as the name suggests, these are general anti-abuse provisions, giving wide range of powers to Indian revenue to challenge a particular transaction if the main purpose, quote unquote, is tax avoidance. So that's, that's a direct taxes code. From an indirect tax perspective, as we earlier spoke, as we said, there are multiple indirect taxes which are in place. So the GST, or the Goods and Services Tax, is something which sorts to unify most of these indirect taxes in a manner which will be simplified. There would be a structure. It is proposed to be a dual structure, which is similar to Canada and not US. So state as well as federal have the rights, but it's one code. And therefore, the credit mechanism and everything works much more smoothly. And as per the economist, it is said that only by implementing GST, the implementation of GST could boost the Indian economy by 1.5%. So that's a significant, savings or the boost to exports which can be generated. The draft is still there, but as it happens in any democracy, there is a thin. There are different people or different stakeholders have different opinion. So it will take some time, but we hope to we hope that this will be implemented in near course. So one other point which I wanted to discuss was as Sajay mentioned, some of the traditional ways of doing business in India, of a liaison office, a rep office, branch office, or a wholly owned subsidiary. One of the latest regime which India has introduced, similar to the US, is the limited liability partnership. Now, this was introduced around 5 to 6 years back. However, for foreign direct investments, some of the rules for US companies or for foreign companies investing into a limited liability partnership was recently been amended. And therefore, we now believe that a lot of US companies should explore the LLP option, especially because it does give some flexibility because the Companies Act is not applicable. So some of the onerous provisions of Companies Act, which we discussed, will not be applicable to limited liability partnership, as well as there are certain tax savings which may be attached to an LLP, and I will cover that in the next slides. Now, as Vinay briefly spoke about, right now, let's take a very simple example. You don't have any international operations, and you want to start operations, and you want to explore the Indian market, and you want to do it. Now, how do you go about it? What is the way you should go? Whether you'll have the US company directly investing into India, or you believe that the Indian operations could be significant, and therefore, there could be some value unlocking, even from a US side, and when I can speak about it, the offshore concept, if you don't want to bring the profits to the US, and if you want to keep outside of US, probably for reinvestment in India or any of the other jurisdictions. So in that, again, depending upon the facts, there could be an option of evaluating an intermediary holding company or a holding jurisdiction between the US and India. So instead of your US company directly investing into India, you could explore some other jurisdiction which could have a tax-friendly treaty with India, and therefore, especially in terms of an exit, if you're looking at exiting your Indian venture, if you are through one of these holding company, you could have a better tax treatment. However, it has to be a substance and form, and the anti-abuse provisions also, which we spoke, could be of an impact.
Jilesh, I'll just add that when I'm having conversations with clients, one of the things we'll look at is who could be, if you're forming an entity in India or somewhere else, who could be the ultimate owners? If they're always going to be U.S. people, sometimes it's simpler not to have a type of intermediary holding structure. But if you could have investors from countries with a low or no tax rate, like the UAE or someplace like that, then sometimes it does make sense to set up a holding company, whether it be in Mauritius or Singapore, so that you're not creating this extra layer of tax.
Exactly. And again, the operations are also relevant. I mean, are you looking from a pure outsourcing or a back office operations? In that case, more or less, you would never be selling your Indian entity. It would be only the US entity which would be sold. Or there are certain profit repatriation, there could be certain benefits, and therefore that is something which can be evaluated. Now, in terms of the tax, besides the income tax, which is broadly at a 30% tax rate in India, when you want to repatriate your profits back from India to the US, and we're taking a scenario where you have US holding India, there is an additional level of tax, which is called the Dividend Distribution Tax. The way it works is the DDT is levied on the Indian company and not on the shareholder, and that income is exempt in the hands of the US shareholder. However, this DDT will be paid by the Indian company. So if there's $100 of profits which you have made in India, paid the appropriate taxes, and you want to repatriate back, then this 17% additional tax will be applicable on the Indian company. When I want to talk about the US.
Yeah, so on the US, the problem with the dividend distribution tax is that it's legally imposed on the foreign corporation, not on the US shareholder. So it's almost impossible to get a US foreign tax credit for that extra layer of the dividend distribution tax. It creates a lot of problems, and which is one of the reasons why I think the new limited liability partnership, right, in India is going to become much more attractive, because we can make an election to treat that as a US corporation, and we still have one level of tax. We don't have that additional level of tax where we have trouble getting a foreign tax credit.
Exactly. So one of the key advantages of what we think of the LLP, today is that unlike in the companies where a dividend distribution tax is applied for repatriating profits out of India, there are no such taxes in the LLP. So essentially, when you operate through an LLP, you just pay the one level of taxation. And unlike in the US, LLP, it's more like a corporate entity, and it is taxed at the entity level and not at the partners level. So it's not a pass-through entity as what you have in the US, but it's just a one layer of tax which is on the company, and then you can get the profits back, to the US without paying the dividend distribution tax.
Correct.
Now, withholding tax. This is one issue, which we often face on a host of clients. Now, every time when an Indian company is making payment to a US company, whether it's a parent or whether it's a franchisee payment, a third party, there are onerous withholding tax obligations which are levied on the Indian payer, right, or the Indian company, and therefore, they tend to ask the documents to see that their appropriate treatment is done. Because if there is any laxness from their part, the Indian revenue can actually go after the payer, whereas the income is not of the payer, it is of the recipient. So that is the reason this is one issue which we face on a pretty routine basis. Just a couple of key documents which we believe which are needed and which you might have your Indian entity or the Indian payer asking for is a tax residency certificate or the Form 6166 from the US.
And I'll just add, that's a straightforward process to get, but it takes 2 to 3 months to get it. So you have to plan ahead.
Budget, exactly.
And the problem is your vendor's not going to pay you until they get that tax residency certificate.
Yeah, so that's why. So it's important to plan your affairs, and not what happens is at the time when the payment is due, let's say you would have raised the invoice and it's due on 60 days. At that point of time, probably the payer will come back and says, hey, I need this document. So it's appropriate to plan your affairs and have these things ready. As Vinay mentioned, it's not a big task, but there is a process and some time which you have to spend at the US IRS level to get it. One more other document which I wanted to note was that 2 years back there was an amendment because of which it made a permanent account number or a tax registration number in India mandatory. to get a lower withholding tax or a lower withholding rate. Taking a very simple example, let's say a royalty. If you are receiving income from an Indian company on a royalty basis, the tax rate under the India-U.S. tax treaty is 15%. However, that 15% beneficial rate is available only if the Indian company has obtained the PAN or the permanent account number.
And no U.S. company wants to get a PAN. It's very controversial because nobody wants to, if you're not otherwise subject to Indian taxation and you're just claiming the withholding rate you're allowed to under the treaty, nobody wants to get into the Indian system in the same way that no foreign company would want to get a U.S. EIN number and get into the IRS's computer system. So I have many conversations with people telling them it's okay to get a PAN.
Yeah, exactly. So just to clarify, it's just a tax registration number that does not create a taxable event. The taxable event would be when you are receiving the income from India. However, practically speaking, we have seen US companies, being hesitant. Why do we need this information? Why do we need to get? What will the Indian revenue do with that? And all sort of questions. Okay. Now, in terms of tax litigation, unfortunately in India, the tax litigation is very high, and probably for that reason, there's an advantage that we lawyers and accountants have enough job, which the Indian authorities take after. Now, transfer pricing is something which I just want to touch upon. That being because that's one of the highly litigious area where the Indian revenue has taken certain aggressive positions. A lot of representations were made, and India have gone ahead and introduced the Advanced Pricing Agreement, or the APA. It was introduced in 2012. The first set of applications were filed in 2013, and we already have 5 orders, which were passed in March 2014. So in a record time of under a year, a lot of these, 5 of those cases are already resolved. We see a huge success, with US companies and a lot of foreign companies trying to explore the APA route, to get tax certainty and end this litigation forever. So this was a welcome move by the government, bringing in this legislation. And again, the body or the revenue officers who are in charge of the APA are extremely senior level officials, personally looking into that matter. And we believe this is something which will go a long way for all foreign companies operating in India. Last not but the least, few other major ticket, big ticket litigation. There have been some transfer pricing litigation on valuation of shares. The reason I wanted to mention that is generally you get a concept, or you believe that it's a revenue. The revenue transactions is where the transfer pricing applies. In India, there is an interpretation that capital account transactions also could be under the purview of transfer pricing, and therefore it is essential that every transaction which you are doing in India, as simple as infusion of capital, is done at a fair market value. So therefore, there is no issue of a transfer pricing perspective. Withholding tax, which we covered earlier, the Nokia deal, right? The Nokia Microsoft deal is under the scanner in the Indian revenue. And from the press reports, we understand that, the Microsoft Nokia deal could be completed keeping outside the Indian, the Indian company, mainly because a couple of $1 billion of demand have been raised on these various withholding tax payments, which Nokia India have made payments to Finland and a lot of other group companies and have not complied with these provisions. Just on the steps which have been taken by the Indian government, besides the APA which we spoke, there have been increasingly in the past, and we've worked with US IBC as well, a lot of representations have been made by foreign companies on these various aspects on a basic principle to provide certainty for any taxpayers. So that is something which in the last 6 to 12 months the Indian government has taken cognizance of. There have been committees which have been set up. There have been certain reforms which are going under, and there have been few changes which have happened, and we do expect a lot more changes in the next 6 to 12 months to address these concerns and bring give more clarity to US investors or any investors operating in India. So those are a few points which I thought are important for US companies operating in India. Any questions? And otherwise we can.
Yeah, maybe.